Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Foreign nations will finally be asked to pay for the privilege of access to our market, the biggest market in the world. We're right now the biggest market in the world.
Trump, tariffs, everyone. The president imposing the steepest US import levies in a century, with China facing a tariff of more than 50%. Stocks plunge and haven assets rally on fears of an escalating trade war. Vowing retaliation, Beijing condemns the tariffs, pledging to hit back, while the EU says it's preparing further countermeasures to take effect next week. Plus, as European investors assess the fallout, we will speak to the president of the German Autos Association and Ireland's Minister of State at the Foreign Affairs Department. Good morning. If you thought the markets were priced for this event, take a look at the screen, take a look at the markets and the data and the action that we're seeing. They had not fully priced the action and the decision coming through. The Trump tariff bazooka. This is now a global trade war. Every single nation hit by tariffs to some degree, from Laos to Lesotho to the EU and China, of course. China facing tariffs cumulative now of more than 50%. European futures then pointing to deep losses on the back of this news, pointing lower by 1.8%. Here in the UK, FTSE 100 futures down by 1.4%. The UK hit with a 10% tariff. S&P futures stateside down by 2.7%. That is what's been flagged in the session. And when it comes to the Nasdaq 100, which of course has already been under pressure year to date, currently pointing lower by 3.2%, with tech the focus given the supply chain ruptures that we're expecting to see as a result of these broad-based tariffs announced by President Trump. Let's flip the board and have a look cross-asset, because this is where you see the safe haven moves around the yen, around the benchmark US 10-year, closing in that 4% level right now. The benchmark 10-year yields down 7 basis points. Money continuing to move into treasuries and traders ramping up their bets of additional cuts from the Federal Reserve as recession risks now loom for this US economy. The Bloomberg Dollar Index is down 0.6%. Money moving into the yen, into the Swissy. That is the safe haven play as well. Oil being crushed in the session, down 2.3%. Gold, another safe haven. The yellow metal, of course, with the gains of more than 18% year to date, up 0.2 in the session so far. Let's have a look at the corporate impact then. Apple in focus, given the supply chain impact and the tariffs. Again, the burden on China, given, of course, the production facilities that Apple has there, but also in nations like India and Vietnam, Mexico. What does that mean for a company like Apple with all of that exposure? The stock is down more than 7% then in after hours. Nvidia as well, given the exposure not just to China, but to the EU, the supply chain picture and what that will mean as those get torn up. Currently, of course, the producer of those AI accelerators pointing lower by more than 6%. And Nike, with the US consumer in focus, having to absorb that additional levy, currently pointing lower by more than 7%. So much of the product, of course, produced and manufactured in nations like India, China and Vietnam. Let's cross over to Asia right now, where Avril Hong is standing by for a check in terms of how things are adjusting in the Asian session. Joining us out of Singapore. What a day, Avril.
What a day. What a massive repositioning we're seeing in Asia's markets. Clearly, investors were not expecting this. These tariff levels much worse than anticipated. So you're seeing that Vietnam stock gauge, 46% tariffs. Remember, the stock gauge plunging by the most since 2021. The Vietnam dong plunging to the lowest on record. Not just that, Japanese stocks are also really underperforming today. It's the drag from the autos, but also the lenders. Remember, these concerns about the global growth trajectory are affecting the BOJ's rate hike path. There was chatter previously about maybe we see something in the first half. Now even September is not a certainty, and those rate hikes would have helped banks' profitability. So unsurprising that these Japanese banks, this gauge of them is dropping by the most since the yen carry trade unwind of August. Flip the board and take a look at China, because as you just highlighted, these levies are worse than expected for them as well. But it's really interesting how we're seeing the gauges managing to pair earlier losses. Mainly also that's happening in the mainland stocks, which tells us that Maybe a lot of the bad news was already being priced in, but perhaps more importantly, that investors now expect authorities to front-load stimulus given the tariff headwinds. Now, flip the board, just raking through as well what we're seeing in the FX space, because the renminbi onshore today slid to the lowest level in 7 weeks. Offshore looking still pretty stable, and it's interesting to pass the signals we're getting from the Central Bank of China, right? Because it is stronger today, the fix versus traders estimates. So signaling they still want to kind of support the currency, but it is the weakest since January. The takeaway here is that yes, these tariff headwinds, maybe the PBOC will let the yuan weaken a little, but they don't want to see rapid depreciation in the renminbi. Amid all this, what's really been shining through today, the safe haven qualities of the Japanese yen. We're seeing it not just moving towards the 147 handle and its outperformance in the Asia Pacific. Keep in mind that it's also not far from the lows of this year, dollar yen of 146.5, really amid these global growth concerns.
Remarkable moves in the Japanese yen, with Goldman Sachs, of course, having called that as a safe haven on those US recession risks. As you say, that currency up more than 1%. Hey, Rohong in Singapore, thank you for the check on the Asian markets and how investors there are adjusting to what is looking like a rupturing of global trade lines from these tariffs. Staying with our top story then, US Treasury Secretary Scott Bessent warning trading partners not to fight back.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation.
Let's bring in Bloomberg's Valerie Taitel. We know, of course, that the EU is preparing to retaliate. China says it will do too as well. Val, talk us through the economic impact of the tariffs that have been outlined by this Trump administration.
Tom, some really interesting analysis right out of the gates from Bloomberg Economics about the potential GDP impact of these tariffs announced yesterday from the Trump administration. The European Union could see a GDP impact of 1.1%, Tom, and that does not take into account any countermeasures coming, which could make the GDP impact even worse. The UK, less scathed with their tariff only 10%. The GDP impact is smaller, not 0.2%. But take a look about the GDP impact from China. Bloomberg Economics sees nearly a 2.8% GDP impact for the Chinese economy. That is a whopping number. Moving on to the export impact. Again, another analysis from Bloomberg Economics. They see a drop of Chinese exports to the U.S. up to 80%, Tom. That is a whopping number. That is rewiring global trade. The EU could see exports drop to the U.S. of up to 50%. The U.K., less scathed out of this, a 20% drop in exports to the U.S. It is in no question that we are risk off, especially in the equity market. S&P futures in the Asia session hit a fresh year-to-date lows. We are off slightly of those lows, but still a 2.7% move to the downside as we see a rally into safe havens. The Treasury curve in focus as well. This is a belly-led rally led by the 5-year sector. Note, Tom, there is no pricing for immediate cuts from the Federal Reserve. The pricing for the May meeting has stayed stable. What the market is pricing in, though, is a lower terminal rate from the Federal Reserve. Hence, we're seeing the move more pronounced farther out in the curve as that 10-year yield gets very close to 4%.
Yeah, and these market moves suggesting that investors think that the US is going to be amongst the worst hit as a result of these self-imposed tariffs, of course, on these major trading partners of the United States. Bloomberg's Valerie Taitel, thank you very much indeed in terms of the economic impact and how markets continue to adjust. Let's get more details in terms of what President Trump actually announced, of course, the US to apply a minimum 10% tariff on all trading partners and additional duties on around 60 nations.
In a few moments, I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Such horrendous imbalances have devastated our industrial base and put our national security at risk. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Nearly a century later, in the face of unrelenting economic warfare, the United States can no longer continue with a policy of unilateral economic surrender. We cannot pay the deficits of Canada, Mexico, and so many other countries. And today we're standing up for the American worker, and we are finally putting America first. And for these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Let's bring in Bloomberg's Katia Dimitrieva for the latest then. Katia, what are the details of the tariffs announced by Trump?
Well, as you said, it's going to hit everyone. There is a 10% tariff on every single country that sends goods into the U.S. There's going to be tariffs as high as 60% on other economies. And it's important to note that these are some of the U.S.'s biggest trading partners. You can think of Japan, South Korea, the European Union. All of these countries are going to be seeing their goods into the U.S. going up in price. And this is something that companies have immediately reacted to. Stocks are down across the board, of course, as we just heard. And we haven't even heard the retaliation yet, because what could exacerbate this is if these economies then come back. You know, we've heard from the EU so far. We've heard from Chinese officials who say that they're going to retaliate against this. And the details of that will really shape how far this goes and how much higher those rates could potentially go.
And Katia, China is, of course, a nation you know very well indeed. Are we looking potentially at the end, if not this year, then in a decade, of most US-China trade? Give us the scale and scope of what is being imposed on China.
Well, it is definitely a possibility. Bloomberg Economics ran some numbers very recently, finding that a 60% tariff rate, which is a number that has been floated by President Trump, would actually decimate most of trade between China and the U.S. Now, we're not at that level, even if you add in the sort of 45% and the 20% that was already imposed. But I think overall, I think that was the conclusion, is that trade would essentially cease to exist. Now, for other countries, they might be able to find exemptions, they might be able to negotiate something, but given China has been such a focus for the U.S. administration, as well as some countries like Vietnam, where they're kind of alleging that there's transshipments happening, it's not likely that they'll be able to reach that agreement.
Katia Dimitrieva, thank you very much indeed with the details on the tariff announcements and, of course, the impact on China, and how China responds, of course, will be crucial in terms of this dynamic. Some lines crossing in terms of the Japanese response. The Prime Minister saying that he and the team will assess there in Tokyo the tariff impact on domestic industries. The Japanese government will protect domestic industries and jobs, they say. As Shiba, the Prime Minister, saying he is deeply concerned over the consistency of US tariffs with the WTO. The WTO has been firmly sidelined, but all of this action, of course. Shiba saying he will not hesitate to talk directly with Trump if necessary. US policies will have significant impact on global trade, saying he is very disappointed over the tariff measures. To the European Union right now, the EU vowing to retaliate. Japan has not done that yet, but the EU is vowing that countermeasure and those, of course, retaliatory steps after President Trump imposed a 20% tariff on imports from the bloc. America's largest trading partner, the European Commission President, says the measure is a major blow to the world economy.
We have always been ready to negotiate with the United States to remove the remaining barriers to transatlantic trade. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel. And we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
Oliver Crook is outside the European Commission headquarters in Brussels. Ollie, walk us through the likely EU response. What have we been hearing, and what has Europe got up its sleeve to respond to a 20% tariff?
The key line there, Tom, from Ursula von der Leyen is if negotiations fail. The EU does not want to take on the United States in a trade fight, in a tariff war. What they would like to see is a negotiated resolution to this issue with the United States. We should say, Tom, that 20% level is close to the worst-case scenario that the EU policymakers were anticipating. They were anticipating somewhere in the ballpark of 10 to 25%. It came out at that sort of 20% level, so very, very elevated. The issue for the European Commission in trying to resolve this issue with the Trump administration is that there are not 20% worth of trade barriers in the form of tariffs between the EU and the United States. What they will probably now need to do is to look at the non-monetary, so-called, this is what Trump kept talking about, non-monetary trade barriers that exist between the EU and the United States in order to sate the Trump administration. And we should say, Tom, this is all happening in a very sort of important context because in the next couple of hours, we will have Marco Rubio, the U.S. Secretary of State, landing here in Brussels, not to talk about trade, but to talk to foreign ministers of NATO. And in that sort of context, European policymakers need to keep the Trump administration on side on the issue of European defense, on the issue of getting a sort of resolution in Ukraine. So all of these things begin to bleed into one another when these sort of negotiations take place. And so for the Europeans, it's going to take a little bit of time. They're going to take some time to assess what the sort of situation is really. They're going to have trade ministers meeting at the beginning part of next week before we get any sort of strong response from the EU. But we should say, Tom, actually, the way in which this could impact the EU the most is not necessarily, I mean, obviously it's huge to have a barrier between the US and the EU, but it is the outflow, the extra demand, the extra sort of supply coming from China, potentially pouring into the EU market. That is going to be front and center for these policymakers to deal with.
That's a crucial dynamic to watch, isn't it? Bloomberg's Oliver Crook on the ground for us, of course, in Brussels with the European response. Thank you. We will, of course, be continuing the conversation on tariffs throughout the show. Our guests include the president of the German Association of the Auto Industry. Those auto 25% tariffs are now in place. And Ireland's Minister of State in the Foreign Affairs Department. Crucial conversations coming up. Stay with us. This is Bloomberg. OK, for more market reaction to Trump's tariffs, let's bring in Tatjana Greil-Castro, co-head of public markets at Muzinich & Co. Tatjana, good morning. Thank you for joining us. What is the medium to long-term market impact of these global Trump tariffs?
Well, this was a profound announcement yesterday, that's for sure. So, and that is really an announcement that is asking for a response. And I think this is where the market is reacting how it is, because this is only the opening salvo. With regards to countermeasures and with regards to European countermeasures, I think they'll be more focused on protecting Europe from potential floodings of markets of excess goods that could come to the market. So I think they will be very much focused, they should be very much focused on those countermeasures. With regards to appeasing the US on agricultural goods, I think that's very difficult because the consumer, there would be an outcry across Europe if those goods came to market, given the GMO, given the way the growth hormones and all those things that Europe doesn't allow and consumers that don't want. So I think it's difficult to appease, because Trump clearly talked about poultry in particular. And we had this in the UK, for instance, with the chlorine chicken and the outcry that we had. Yeah. I think there's difficulty to lower some of those non-tariff barriers. With regards to the resolve and the industrial policy, we have set it for the last few weeks. There is a shift in industrial policy by the US, and you can see that how the equity market has responded in the US, because clearly lots of US companies are affected by those tariffs as they're importing from abroad. That's just the point, right? That they shouldn't be importing all those goods from abroad. They should bring production back home. So there will be a near-term impact on that. So that's the first response. But at the same time, the second, and it has already been announced, planned tax cuts, all those things. So, and the European response, the Chinese response with regards to consumer stimulus, European response probably with regards to structural reform, and as von der Leyen said, really coming together as a unit. So all those things are actually positive for the individual regions. And in that regard, we actually think that the equity market so far, the response has been quite muted. Is this going to be all of it? We'll have to see what the response and counter response is.
Tatjana, does the bond bull market then have further to run? And if so, where do you want to be positioned?
So we have been positioning for the last few days, really reducing our credit exposure. So we think that there could be further spread widening. There's been some spread widening, but really very marginal. And so depending on how this shakes up, but clearly there will be a slowdown in growth. So that means we have reduced our credit risk, and we prefer all-in US rates. So we think that will be the safe haven with regards to fixed income. So we've been extending duration in the US. We are more cautious on European rates, and that is because of the growth stimulus we are expecting out of Europe, which will be probably more quickly announced than what we hear from potential tax cuts in the US.
Do central banks ride to the rescue?
We expect the ECB to cut in April again, and then we'll have to see what Powell says clearly on Friday with regards to the overall impact. And there is really, we are on the knife's edge with regards to, is the growth impact overriding? And that clearly then the Fed would respond to that, or is the inflation impact overriding? And I think we really have to listen what the Fed is saying, and that we'll probably get a better idea in the next few days.
OK, Tatjana Greil-Castro, Public Markets Co-Head at Muzinich & Co. Thank you. With reducing exposure to credit and US Treasury still the safe haven play. Tatjana with the insights and the market reaction, of course, on a momentous day for global trade. Coming up, as President Trump's 25% tariff on US auto imports took effect shortly after midnight in Washington, we get reaction from the president of the German Association of the Auto Industry. That conversation coming up. This is Bloomberg. The UK has refrained from retaliation and says it will maintain its push for a US trade deal after President Trump slapped tariffs on 10% of all imports from Britain as part of a wider global package. Capital Economics has estimated that the US imposition of 10% tariffs on UK goods would shave between 0.01% and 0.06% off Britain's gross domestic product. That, of course, doesn't include the broader impact of the squeeze on global trade and the impacts on the UK economy. We're going to be speaking, by the way, just after 9 a.m. with Jonathan Reynolds, the UK Secretary of State for Business and Trade, to get his reaction to President Trump's tariffs. He's been leading those UK negotiations with his US counterparts. NATO Secretary General Mark Rutte said European militaries should step up as the US tilts away from the region to focus more on threats from Asia. Asked about a media report of potential US war planning with China, Rutte acknowledged a US pivot toward the Indo-Pacific region, even as he reiterated that Washington has no plans to withdraw from Europe.
It is understandable also for the US that over time they want to focus more and more also on that part of the world. And it is only logical for the Europeans to step up even more.
Let's check back on the market reaction, and the pricing in terms of the future story tells one of expectations that the US is going to be worse hit than many other counterparts, maybe not including Japan. The Nikkei is down heavily in the session, as you can see, down 3.3%. The auto sector, of course, tariffs kicking into place. They are now in force, 25%. European futures pointing lower by more than 2%. Nasdaq 100 futures looking to drop 670 points, down 3.4% after already, of course, falling substantially year to date. And the moves in terms of the Swissy gaining 1%. That's the biggest jump we've seen since November on that safe haven tilt. You're seeing similar story for the Japanese yen. The gold as well continues to see some upside. Coming up, we look at the auto industry and the tariff impact. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Foreign nations will finally be asked to pay for the privilege of access to our market, the biggest market in the world. We're right now the biggest market in the world.
Trump, tariffs, everyone. The president imposing the steepest US import levies in a century, with China facing a tariff of well over 50%. Stocks plunge and haven assets rally on fears of an escalating trade war. Vowing retaliation, Beijing condemns the tariffs, pledging to hit back, while the EU says it's preparing further countermeasures to take effect next week. Plus, as European investors assess the fallout, we will speak to the president of the German Autos Association and Ireland's Minister of State at the Foreign Affairs Department. Checking in on your markets then. The route is there for the equity story. You're seeing significant selling pressure over in Japan, over in South Korea. The 25% auto tariffs have been implemented. An additional, of course, 10% globally. Trump has pulled the trigger on this global tariff bazooka, rupturing global trade if, of course, those come into play as expected next week. European futures then dropping 2%. We wait for the countermeasures from the EU, likely next week. FTSE 100 futures pointing lower by 1.6%. S&P futures stateside plummeting like a stone, down 3%. Nasdaq 100 futures, after dropping at about 8% year to date, looking at further losses, pointing lower by 3.5% for that tech-heavy index. Let's flip the board and have a look at the safe haven moves. Treasuries are rallying. The Swissy is bid. The yen is bid. Gold is getting more upside. Fresh records for the yellow metal. Currently, the US benchmark 10-year at 4.04, closing in on that 4% level. Do we cross below it in the next day or two? Currently, a move of 8 basis points lower in yields. That's seeing across the Treasury curve. You're seeing a bid for Treasuries. The Bloomberg Dollar Index also dropping, down 0.8%. That's giving some upside to the pound, to the euro, to the yen. Brent down 2.5%. Oil prices plummeting on trade angst and recession risk. Gold, the yellow metal, actually down 0.2%. But again, that's given the 18% rally year to date for that safe haven asset. Trump's tariffs then poised to shake up global firms, even across the same sectors and geographies. Everyone from Cambodia to Lesotho to Madagascar to the EU to China being hit by tariffs. Bloomberg's Charlie Wells joins us to put the levies under the microscope with a particular look at the corporate impact. Charlie, how are these tariffs, these additional taxes, likely to impact corporates? Who's in focus for you?
Tom, so the dividing line really is, what are your U.S. sales? How much do you make in the United States? And where do those ingredients come from? And so interestingly, European alcohol companies show a really interesting split screen here. So if you look at the likes of, say, Diageo, they've got 39% of American sales, but you can compare that with AB InBev, also European, but they're just having U.S. sales of about 25%. But it's not just about those sales. It's also about, as I mentioned, those ingredients. This partially explains why a subsidiary of AB InBev, Anheuser-Busch's CEO, spoke recently about how 99% of their beer is brewed in America. 99% of those ingredients are American. But it's not just geography, and retail tells this interesting story. It's also the business model. And so if you kind of compare and contrast the likes of Discounter, Target in the United States, they've got a lot of China exposure. That is putting their share price under pressure. Compare that to a different business model, same sector though, TJ Maxx. They kind of resell overstock. And so that kind of puts them in a sort of boon position right now where they could potentially resell overstock that companies have really been piling up since news of these tariffs. And I've got to end on autos because that has been so much in focus. You could call them something of a winner today if you want to use that word, because they are not subject to these additional tariffs. But those 25% tariffs, of course, came into effect just after midnight, and we're seeing a really mixed picture here.
Charlie Wells, fantastic breakdown of the corporate story and the impact and how that is dividing up. Charlie Wells, thank you for that analysis. President Trump's 25% tariff on US autos, as Charlie was mentioning. We'll get more details on that now. They are now in effect. They're expected to dramatically, of course, increase costs and upend industry supply chains. Let's get reaction now from the president of the German Association of Automotive Industry, Hildegard Muller. Hildegard, thank you very much for taking the time. What is the impact likely to be on your members as a result of these 25% tariffs now in force?
Yeah, good morning. I think this kind of protectionism will only produce losers. We have in the United States 2,000 companies from the German automakers with around about 140,000 employees. We are producing 840,000 cars in the US. That's a great commitment. And we are able to produce cars for the consumers with prices that are for them available. This kind of tariffs leads only to a spiral of protectionism. The products will be much more expensive. We will higher inflation rate, and that causes all the consumers in the US.
Well, President Trump wants your members to build more factories and have more exposure and more production in the US. Are they prepared to do that? Will they be doing that?
That's absolutely open because there are not clear investment procedures with the president acting like this. We are invested in the US. We have a great commitment to the US. It's absolutely open to invest more at the moment.
Will we be seeing further factory closures and job losses in Germany as a result of these tariffs?
No, I don't think that. But at the end of the day, all the companies, also the US companies are against these tariffs because the products also from the US companies will be more expensive because of the supplier question that's also stick with tariffs. So the whole market will get to a kind of imbalance. The results for employment all over the world are at the moment open.
To what extent can these tariffs be absorbed by your members? How much is going to be absorbed in terms of squeeze on the margin? How much is going to be passed on to the consumer?
Yeah, I'm sorry, I can't talk about concrete prices because it's due to the cartel law. The company has to do that themselves. But 25%, sure, they are not able to put it in the supply chain. They have to give it to the consumers, and that means higher prices at the end of the day. How much in which car, I can't bring out here.
OK, but higher prices are coming for the consumer. Mercedes reports that Mercedes are looking to pull one of its lower-end models from the US market. Do you expect other models to be pulled from the US market from other automakers?
No, I think that we will bring automotive industry in the US. We announced it, and as I mentioned again, we have 2,000 plants in the US, and we have 140,000 employees. It's a great commitment. We want to share not only markets, we also want to share the supply chain. So we are in an ongoing discussion. We can't see that the tariffs support this line, and at the moment, the whole international supply chain will be mixed new. And I'm absolutely sure that the European Union, that Japan, Canada, Korea, and all the others you show here will react together.
Yeah. Should the EU retaliate? And does your industry need a support package from the German government?
I mean, they have to react robust. At the end of the day, this leads to a spiral of protectionism, but we try to avoid. So we need negotiations to show the instrument both sides have. And maybe there are some other opportunities. We have in 2018, we had also a situation like this. At the end of the day, we find a solution. So we just try to have talks together and to avoid the situation.
OK. Hildegard Muller, president of the German Association of the Automotive Industry, as these 25% tariffs on the auto sector are now in force. Thank you for your reaction to that. Coming up, we're going to speak to Ireland's Minister of State at the Foreign Affairs Department on how Trump's tariffs will hit the Irish economy and that EU response, of course. That exclusive conversation is next. This is Bloomberg. Trump's new tariffs also hitting corporate America. Bloomberg's Valerie Teitel is going to join us, break down some of the big moves. Val.
Tom, let's start with the retailers, especially those with a particular exposure from Vietnam, sank after hours after this announcement from the Trump administration. Nike down 7%, Gap down 9%, Lululemon down 11%. These are all retailers with exposure to Vietnam, which got a whopping tariff number. Moving on to retailers with exposure to China, especially those that source goods from China. Walmart down 7%, Amazon down 6%, and we have to end on Apple. Tom, China China's Apple supply chain is heavily exposed to those that got whopping tariff numbers yesterday. China, India, Vietnam, all tariff numbers above 30%, which Apple is very highly exposed to. Those shares sank 7% in the aftermarket, leading losses for the Mag 7 in extended trade.
OK, Bloomberg's Valerie Teitel, thank you very much indeed. Trade tariffs, of course, threatened by US President Donald Trump, risk dealing Ireland a 3.5% hit to its projected GDP, 3.5% in the medium term. That is according to a paper from the country's finance ministry. I'm very pleased to say I'm joined now from an exclusive conversation with the Irish Minister of State at the Department of Foreign Affairs, Neale Richmond. Neale, thank you for taking the time. I, of course, want to get your views on the EU response, but let's start with the impact on Ireland. What is your expected take in terms of the broad-based impact of 20% tariffs on your Irish economy?
Well, to be honest, Tom, it's going to take us probably a couple more days just to work out the full impact. One notable point in the follow-up paper announced by the White House last night was that tariffs on the pharmaceutical sector have been delayed, albeit just for now. That's obviously a particular sector that Ireland is extremely exposed in. But overall, this is bad news. Let's not beat around the bush here, Tom. This is bad news for Ireland. It's bad news for Europe, the UK, and the United States. Tariffs are a bad thing, particularly of this scale, but we're going to react calmly and surely. You referenced a paper that our Department of Finance under my colleague Pascal Donoghue, who's also president of the Eurogroup, released last Friday. That maps out in fairly stark terms the impact these tariffs will have on the Irish economy in the medium term. We will see about the loss of 80,000 jobs in terms of creation, as well as a hit to our continuing economic growth.
OK, so the pharmaceutical sector, as you rightly say, carved out, at least for now. Which sectors face the most pain as a result of 20% tariffs in Ireland right now? Which sectors are you most concerned about?
Well, certainly pharmaceuticals is one that we are keeping very clear in our mindset in due course. The agri-food sector is such a big employer where we're exporting high-end beef and indeed whiskey, as well as so many other products to the US. It's also the light technology sector, the manufacturing side of things. It's going to have an impact on every sector, Tom. It's going to have an impact on every facet of the Irish economy, indeed of Irish society. But none of this, it must be said, is a surprise. President Trump has been talking about this throughout the campaign. We have been preparing since long before November. We will and must weather through it, as bad as it is.
What retaliation measures have you recommended to the EU?
Well, what we've been very clear, we've been in constant discussion with our European partners, is that the EU doesn't need to react instantaneously. First of all, let's wait. There's a timeline when these tariffs actually come into place. There's quite a bit of work needed in terms of digging through the detail and looking for, further announcements and everything else. So we very much have been advising the EU to let's take our time. Let's be the calm, reasoned voice in this discussion. President von der Leyen said in her address to the European Parliament in Strasbourg this week that all options are on the table, and rightly so. And we expect that there will be countermeasures. There has to be countermeasures. But, and this is crucial, Tom, this has to lead to a negotiated outcome. This disagreement will have to end the agreement.
Minister, it is a negotiation. So what are you prepared to give up in that negotiation?
Well, I don't think it's about giving up anything at this stage, Tom. It's about what measures the EU can use to make sure that we negotiate from a position of strength. Let's not forget, the EU is the world's largest economic bloc with a population of 450 million. That's why Ireland negotiates as a part of the EU, not as Ireland alone. Otherwise, we'd be fairly small fry in this discussion. Our Taoiseach and our Taoiseach, our Prime Minister and Deputy Prime Minister, will stay in touch with European commissioners throughout the weekend. I've had European ministers of various guises coming into the Department of Foreign Affairs all week. And this will lead towards the meeting of our trade ministers on Monday in Luxembourg, where these decisions will be ironed out again.
FDI, foreign direct investment, clearly a crucial part of the Irish economic model. What changes are you seeing there as protectionism is on the rise?
Yeah, certainly this is something that we'll start to see over coming weeks and months. Many of our really wonderful employers will slow down their expansion in Ireland. Just for the record, 10 of the world's 10 largest pharmaceutical companies have major operations in Ireland. 15 of the world's largest tech companies have operations here. They've been really good for the economy. They're good employers that pay a huge amount of tax. But we have got a lot of windfall corporation tax in recent years. But Tom, we haven't been spending that. We haven't been putting that into current spending. That has now been put into effectively sovereign wealth funds that if we need to reach into in the coming months and years, we will, as well as working with European partners. But we have seen a marked slowdown, but we are still seeing job announcements. We are still seeing growth. And now is the time, as President von der Leyen said in Strasbourg, now is the time that we really have to look at the diversification of our trading arrangement, bringing forward the finalisation of the CETA trade agreement with Canada, as well as maximising EU trade deals with Southeast Asia and other countries. But there will be a trading relationship with the US going forward. It'll just be very, very different.
Yeah, and indeed, look, you talk about the success that Ireland has had, of course, in playing home and hosting those US tech companies. Have you had reassurances from the European Commission that part of the countermeasures and the retaliation will not go after US tech?
Well, as I said, President von der Leyen has said all options are on the table, and they have to be on the table. But now is the period where the European Commission, and Ireland is part of the European Union here, this isn't some foreign entity making a decision for us. We'll look at what actual measures can deliver the best results for European citizens, making sure we bring the United States to the table, making sure that if you are going to bring in countermeasures, that they're targeted. Ultimately, tariffs are in nobody's interests. We didn't start this trade dispute, but we certainly want to finish it as swiftly as possible, protecting as many Irish and European workers as possible. But I will say, and tech, in particular, I have Microsoft in my own constituency, less than 2 kilometres down the road from my home where I'm speaking to you from, 3,750 employees. Just 2 weeks ago, the global CEO of Microsoft came out and absolutely confirmed their medium and indeed long-term commitment to Ireland.
OK, and you think that long-term commitment, because it is the goose that lays the golden egg for Ireland, you think that long-term commitment survives potential countermeasures? You must be concerned that Brussels goes after US tech and damages your prospects.
I think it's really important when we talk about the FDI sector in Ireland, be it tech, be it the life sciences, be it any other form of manufacturing, they're not in Ireland for the weather. They're not in Ireland just for tax code. They're not in Ireland just for tariff relations. We have an extremely educated workforce, the most educated workforce in the European Union, English-speaking, common law jurisdiction, full access to the world's economic bloc in the EU single market, as well as special access to the United Kingdom through the common travel area. There's a lot going for the Irish economy. We do absolutely face into an existential threat, and in the coming days and indeed weeks, we'll be working with European partners to make sure that any countermeasures, and there will be countermeasures, are designed to be deliberate and effective and really ultimately lead to a resolution of this awful situation that President Trump has created.
Minister, presumably you agree with Canadian Prime Minister Mark Carney when he says the US is now an unreliable partner.
I think you have to separate the US from the current US administration. America has been a really, really good partner of Ireland in particular, but the EU, the trading relationship between the EU and the US is worth 1.4 trillion euro. You can't just dismiss that overnight despite these, generational tariff announcements that we saw yesterday afternoon, yesterday evening our time. From an Irish point of view, the relationship has to endure. It's so important, not just to our economy, but our society. Over 40 million Americans have Irish heritage. The relationship on an economic basis, due to the actions of this administration, this president, driven perhaps by the Commerce Secretary, will change ultimately in the short term. But now we enter into a phase of discussion, negotiation, to make sure that we continue to work with the Americans. In some guise, the relationship has changed. It'll be a little bit different, but it's still one worth working on.
OK, Neale Richmond, Minister of State at Ireland's Department of Foreign Affairs, with Ireland's reaction to these tariffs, 20% on the EU, which of course includes Ireland. Minister, thank you for your time. There's plenty more coming up. We stay on the tariff impact. Stay with us. This is Bloomberg.
It's the perfect entree to let's make a deal.
He's ran on this for the last 4 years, really, is that he needs to make sure that the other countries are paying what they deserve.
There was nothing truly consistent about this rollout. each country truly is affected differently and to a higher degree than what I think many were factoring in.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number.
It's going to be a very, very bumpy road, and we may well look back on this as sort of a knife edge of the economic prosperity of the United States for some time to come.
Some of our guests, of course, speaking and reacting after President Trump's tariff announcement, and that tariff tidal wave having a global impact. The waves higher and more powerful in different parts of the world. The emerging market space will be crushed in terms of the trade flows into the US on some of these proposed tariffs, reaching up to 49, 50% in some cases. When you think about Lesotho, when you think about Cambodia, when you think about Vietnam, 46%. China, of course, the second largest economy globally, 54% total tariffs. That's not including the 13% imposed during Trump's first administration. You add that together, and of course that gets you well above 65%. 65% tariffs on US goods, Chinese goods into the US market. Think about the impact on companies like Walmart and Costco. Let's flip the board and have a look at the market reaction to this. Europe, of course, being hit with 20% tariffs, and the European response is promised next week. This is how the market reacted yesterday, of course. Volatility on the first reaction to that 10% announcement. Globally, there was a little bit of upside, and then, of course, the details came out, the nuances came through, and the market reaction, of course, has turned deeply negative, with the pressure coming through in terms of the US future picture, with the Nasdaq 100 called lower by more than 3%. Europe, of course, set for a brutal day of trading as well. The Nikkei over in Japan, given the strength of the yen and the impact of more than 20% tariffs, 24% tariffs on Japan, front and centre in terms of the market sell-off. Let's flip the board and have a look in terms of how the currency story is adjusting. The Swissy is bid, the yen is bid. Goldman Sachs' call a couple of days ago that 140 on the yen, and strength for that currency on US recession risks seems pretty pertinent given what we're seeing in terms of the flows today. 147, the Japanese yen up 1.5% versus the US dollar. The Bloomberg dollar index slumping 0.8%. The euro gaining 0.9 for the single currency, and the Swissy bid as well. This is the strongest level we've seen since about November for the Swiss currency. That safe haven tilt up 1.1%. In terms of the 10-year, you're seeing money moving into US Treasuries. The 5-year is bid, the 10-year is bid. This is seen across the curve. 9 basis point move right now. Do we get below 4%? US futures being squeezed. S&P looking to drop 3%. Nasdaq as well, more than that. Brent oil prices plummeting 2.5%. European futures set again for losses of more than 2.2%. We're going to speak to US Commerce Secretary and hear from him. Stay with us. Opening Trade is next. This is Bloomberg.